We're going to look at Visa for the next minute, and then after that we'll look at Apple and Goldman Sachs. But just to show, there's so much that's misunderstood about the option market. There's so much noise out there and it's just not necessary. So let's look at the simplest idea. If we sold a put spread in Visa for the last 3 years every 30 days. All right, we see a 46.2% return. Let's go ahead and see what happens if we took out the risk of earnings. That is, when earnings came around, we closed the position, we let earnings occur, and then we started the position again. We do that with the click of one button. Never trade earnings. We can see a 46.2% return went up to 57.7%, and we're taking massively less risk. So this was a great move. Most analysis will stop here if it even gets this far, but there's just more to be learned. Is every month where you trade puts the same for Visa? Let's take a look. We can go to our custom earnings handling, and what we're going to do is see what happens if we just waited for 2 days after earnings, we sold the put spread, then 29 days later we closed it, and that's it. That is, we traded for 1 month, but not the other 3. And now we can see the results, a 79.1% return. But even though this is over 3 years, it was over just 12 earnings cycles, 1 month per earnings, which means that this 79.1% return is actually annualized. And the idea was straightforward. Here are the various strategies. The first one was to sell a put spread at all times. The second one was to sell a put spread but avoid earnings. And the third one was simply to look for the months where it made the most sense. Now there's logic behind this trade and we have that in a dossier. But let's go a step further. This doesn't just work for Visa. Let's take 2 radically different companies. Let's take Apple and Goldman Sachs and see how these 2 companies did with the same approach. If we just sold a put spread in Apple and Goldman Sachs over the last 3 years, every 30 days, with Apple we would have made about 40%, and with Goldman Sachs we would have actually lost 7%. Now let's take out the risk of earnings. The return in Apple has gone up significantly, and Goldman Sachs has turned from a loser to a winner, and again we're taking significantly less risk. But let us ask the same question. Are there months where we simply shouldn't be trading this strategy? We'll go back to our custom strategy, we'll open the put spread 2 days after earnings and close it a month later, and that's it. And here are the results. The Apple return has gone up almost 4-fold, reducing the number of months we're trading by 67% and avoiding earnings. Goldman Sachs went from a loser to a pretty nice winner. And again, all we did was examine these 3 approaches. There's so much more to the option market that can be discovered relatively easily. Thanks for watching this short demonstration of one feature on the CMLviz option backtester. We hope you'll join us and see all of the features.